Hello everyone, welcome to e-commerce Launcher. I am Divya. Hope you all have watched the intro video of e-commerce Launcher. So as mentioned, initially I will be dealing with the syllabus of plus 2 accounting. So this is the first video on a lesson. So let's see partnership accounts. I know that this is not the first lesson. First lesson is about accounting for not-profit organizations, which we will discuss later. For now, we will deal with partnership accounts. The part A of accounting is full of partnership accounts. That is, it is a very elaborate subject. It's a very big subject in which we will study about admission of a partner, reconstitution, dissolution, etc. etc. So let's start the lesson. First, we will see the contents of this lesson. Friends, first thing that we will deal is the meaning of partnership. Now comes partnership deed and the third one, accounts of partnership firm. In accounts of partnership firm, I am just dealing with capital and interest on capital. Because if I include all the contents, all the topics here in the same lesson, this lesson will be very lengthy, which will be very boring for you. So I splitted the contents into small segments that we will discuss in coming videos for my convenience and for yours. Okay. So now let's start the lesson. Partnership. When the business grows, the requirements like capital, infrastructure, man, material, everything will be high. So in such situations, two or more persons will join together, and when they enter into this joint business, they will contribute an amount as capital. There is no compulsion that it should be in cash. It can be in the form of assets also, like land and building or machinery, anything like that. The partner, the persons who enter into this joint business will contribute. So they are introducing a capital in the form of either in the form of cash or in the form of assets or in kind. Also, they will agree or they agree to share profits or losses in an agreed ratio. There is no compulsion that it should be shared equally. It is all depends on the choice of the partners. So, such a relationship in which two or more persons agree to share profits and losses in an agreed ratio is called partnership. Okay, got it? And the law relating to this partnership is contained in Indian Partnership Act 1932. So we have studied the definition of partnership. I'm not going into an elaborate theory because you have studied this in your plus one business studies. So I'm not explaining the definition is not explained here, which is readily available in your textbooks. You can go through that. So the law pertaining to this partnership is Indian Partnership Act 1932. You remember the definition, that is Indian Partnership Act 1932 defines partnership as. So this is the act that is relate to the partnership. Now the persons constituting the partnership, they are individually called partners and they are collectively called firm. Okay. They are individually partners and collectively they are called firm. They have no separate legal entity. They are treated as a single person under law. But inside the business, they are treated as collectively as a firm and individually they are treated as partners. Okay. Now, Partnership accounts do not introduce any new principles of bookkeeping. The same principles that we follow in the case of a sole proprietor is followed here. Okay. Now comes the other point, that is partnership deed. As partnership is a result of an agreement between two or more persons. So there is an agreement, isn't it? They agree to share profits and losses at an agreed ratio. So it is an agreement. And this agreement can be in oral or written. It is always desirable to have a written agreement because we can avoid disputes later, but there is no compulsion to have a written agreement itself. Okay. So when there is a written agreement and it is signed by all the partners, it is called partnership deed. Okay. So that's all about the partnership and partnership deed. Now the other topic, that is accounts of partnership firm. First topic is capital accounts. Capital accounts of partners. So before getting into that, we should know what is a capital. What is a capital? A capital is something that a partner contributes into the business, or something that becomes the fund for running the business, that is contributed by the partner in the form of cash, either in the form of cash or in the form of assets or in kind. Okay, so it is the partners who decide what amount each one should contribute. The partnership deed does not mention that this much amount should be contributed, nothing like that. All that depends upon the partner's choice. Now, it is not compulsory that partners should contribute equally or even proportion to the profit sharing agreements. Nothing like that. All that is partner's choice. And also the capital can be in the form of cash or in the form of stock, furniture, machinery, anything. Okay, so clear about capital? Now, a separate capital account is opened for each partner and the amount introduced by him will be credited to this account. Okay, a separate capital account. Separate capital account is opened and the amount that is contributed by that partner is credited to this account. Now one thing that you should keep in mind is, we said about the capital accounts. There are two methods of maintaining these capital accounts. See, next thing, the methods of maintaining capital accounts. There are two methods. One is fixed capital method, other one is fluctuating capital method. Okay, in fixed capital method, there are two accounts, or for each partner two accounts are opened. One is capital account, other one is current account. Okay, under fixed capital method. So two methods of maintaining. First one, fixed capital method, in which we are in fixed capital method, two accounts, one capital account and the other one current account is opened. Now see, the partner's capital account under fixed capital method, the amount of capital alone, only the amount of capital is capital contributed by the partner, either in the form of cash or in the form of asset, is recorded in the capital account. All the other entries, all the other adjustments like interest on capital, drawings, interest on drawings, salary, share of profit, commission, interest on loan, everything is shown or recorded in the current account. Okay. Thus, as said, only the amount of capital is recorded in partner capital account. So, the capital of the partner will remain the same after year. Unless he contribute an additional capital, the balance in that account will be same. Okay, that is fixed capital. So, a fixed amount of capital is maintained in the account under fixed capital method, because all the other adjustments are recorded in current account. So, there are two accounts under fixed capital method. Got it? Now, in the case of fluctuating capital method, what happens? Only one account is maintained, that is capital account. Okay. In this capital account, capital and all other adjustments are recorded in the capital account itself. So, the balance will fluctuate year after year. Isn't it? This is what is done in fixed capital method and fluctuating capital method. Is it clear for you? Now comes interest on capital. What? Interest on capital. Interest on capital is allowed to partners as a percentage of the amount of capital they have contributed. Why we are allowing? A question may be asked that why we are allowing an interest on capital to the partners. As said, they are treated, they are under law, they are the same, but they are individually, they are treated as partners, and for each and every partner, separate capital accounts are opened. Okay. The logic behind providing this interest on capital is that there are situations in which partners contribute equal amount of capital, but they will agree to share the profits and losses unequally. In such a case, the partner who have less share will be affected financially. Isn't it? Same way, if the partners are contributing capital in unequal amounts, but they are sharing the profits equally, in such a situation, the partner who contribute higher amount of capital is affected financially. Is it right? So, in order to solve that problem, the interest on capital is allowed, because interest on capital is allowed as a percentage of the amount of capital they brought in. Okay, this is the logic behind providing this interest on capital. Now, this interest on capital is credited to partners' capital account or current account, depending on the methods of maintaining capital accounts. Either if they are following fixed capital method, then this interest on capital is credited to partners' current account. If they are following fluctuating, the interest on capital is credited to capital account. So it is credited because it is in the income of the partner, but for the firm it is an expense. So it is debited to interest on capital account, and finally it is transferred to profit and loss appropriation account. For the firm it is an expense, and so it is debited to interest on capital account. Okay. And finally it is transferred to profit and loss appropriation account. See, profit and loss appropriation account, which I will discuss later in coming lessons. So, is it clear for you? I think this lesson will be useful for you. If so, kindly share this lessons with your friends. And if you have any doubt, don't hesitate to leave a comment so that I can clarify your doubts. And if you like my lesson, please subscribe my channel, give a thumbs up, share it with your friends, and thanks for watching.